Good evening and warm welcome to all the participants. This is 130th Leadership Conversation, and I take it my pleasure to invite all of you. We are very grateful to Mr. M.R. Raghu for joining as the leader speaker this evening. Please join me in welcoming. Sir, good evening and welcome you to this leadership conversation. I am very happy that you have agreed to spare some time for us. We are quite eager to learn from you. Uh, what I will do is I will do a small introduction and hand it over back to you for your opening remarks. Kindly allow me to share my screen. WiseViews leadership conversations are now a regular phenomenon every Friday at 6:30 p.m. We are on the 130th session, as I mentioned just some time back. In this 130th session, we are talking about key risks for 2024, and this is helmed by Mr. M.R. Raghu. And we would like to know a little more about Mr. M.R. Raghu. This introduction and the opening talk by the leader will be for about 25 minutes, and the remaining 40 minutes or so is going to be the Q&A. So there's greater room for interactivity. Let's hope for having very good questions from all of you. Mr. M.R. Raghu is the CEO of Marmore Mena Intelligence, a subsidiary of Kuwait Financial Center Markaz, a leading asset management company based in Kuwait with assets under management exceeding $3 billion US. He's also functioning as economic advisor to Kuwait Financial Center Markaz. In a career spanning more than 33 years, he dedicated nearly 22 years in the Gulf region, covering Riyadh, Bahrain, and Kuwait. Prior to this stint in the Gulf region, he worked with several leading institutions based in India, including the largest mutual fund unit trust of India and the largest engineering consultancy, Mecon. He provides regular opinions on markets, economies, sectors, and other business angles through various blogs, columns, and speeches. He specializes in big picture research with a keen interest in energy markets, asset management, investment research, capital markets, and GCC. He obtained CFA charter from the CFA Institute, USA in 2003, and is a certified financial risk manager, FRM, from the Global Association for Risk Professionals, USA. He's also a fellow member of the Institute of Cost Accountants of India. He was actually associated with CFA Institute as a volunteer since 2003. He was the founding board member of CFA Bahrain Society and founding president of CFA Kuwait Society. He was also a member of Education Advisory Committee of CFA Institute. He attended a 2-week investment management workshop at the prestigious Harvard Business School in 2007. Apart from all these professional engagements, Mr. Raghu plays Carnatic flute. He enjoys motorbiking. He plays online chess, watches cricket, and reads non-fiction books. Amazing. Thank you once again and welcome, sir. I also would like to take a moment to introduce my senior colleague, Professor R. Prasad. He is the Senior Director of Academic Wing at ICFAI Group. He brings a rich experience of 3 decades as an entrepreneur initially and also now as an academic. He is an alumnus of IIT Mumbai and IIM Kolkata. He authored several articles in various journals, edited books, and presented papers in various conferences in India and abroad. Welcome, Professor Prasad, to you as well.
Thank you.
I'll stop sharing my screen here, and we are quite eager to learn from Mr. M.R. Raghu. Mr. M.R. Raghu was also my senior who worked here in ICFAI long back. I did not meet him at the time because I was not there in the organization, but it's a great opportunity for me to connect through Mr. Pattabhiram, a friend and well-wisher who has connected me to Mr. M.R. Raghu. It's a great opportunity, great moment to learn from you, sir. Over to you. And once again, thank you for joining.
Many thanks, Sudhakar, for that very kind introduction. And thank you, Prasad. Nice meeting both of you. And a big thanks to all of you for having me over. Yes, I worked in ICFAI a long time back. I think it was between 93 and 98, and I was directly working with Mr. NJ Sashwi, and yeah, it's a period that I cannot forget in my life. He's a great boss. He was a great mentor, and we had a great time together at that point, actually. And then I went abroad and never came back until recently. So, but it's a good exposure for me because I was quite young, uh, an upcoming analyst myself, and then I was given a very senior position, and it was brilliant working with him, actually. Thank you very much. And today, as I was telling Sudhakar, that even though I'm based in India, I work for a Kuwait investment bank, and therefore my research has always been global markets, because we have clients that invest globally. So I come from that perspective. So my presentation is going to be focusing on key risks or challenges for 2024, and but from a very global perspective. But towards the end, I will try to connect the dot with India, but it won't be the bulk of the presentation. The bulk of the presentation is obviously going to be the global scenario. So please tell me if the slides are showing up.
Yes, we can go full screen.
Yeah. Okay.
Thank you, sir.
So basically, as we move into 2024, we'll be covering 5 key themes of importance. And if at any point some of the aspects are a bit technical, then you are most welcome to ask me during the Q&A sessions, and I'll be glad to explain all of that. But the big picture is that global economic outlook for the world, as well as for the developed economies, which includes USA, Europe, and UK, and emerging markets like China and India, are presented here. And we can see that vis-a-vis 2023, 2024 is going to be a slowdown year, as we can see from the numbers from IMF. So across the board, at the global level, it's not too much of a fall, but it is falling from 3% to 2.9%. But US is the growth engine for the world for the last few years, and that is going to slow down a bit from 2.1 to 1.5, though we are seeing some green shoots for Eurozone and UK. But what about emerging markets? The emerging markets, mainly China and India, used to be the incremental growth contributors for several years. But China has been slowing down of late, and it is expected to slow down in 2024 from 5% to 4.2%, while India is the only shining star in that list with about 6.3% growth projected. And that probably counts as the strongest growth among all the countries that we can count. That's why you see our stock markets are red hot at the moment. So the sum and substance, it's going to be a slowdown year for 2024. And it may not be a recession, but definitely it's a slowdown. Obviously, last 2 years, especially last year, the topic of concern for everyone in the financial markets has been inflation. In 2022, inflation hit a peak at 8.7% globally and 8% for US. These are extraordinary numbers for these economies. These economies target inflation rate is about 2%. So 8% would mean a 4-fold increase in inflation. And that has cooled down significantly in 2023. As you can see, for US, the inflation halved to 4% now. And UK also has been running a very, very high level of inflation and Eurozone, and thanks to the Russian war, and that is also seemed to be cooling. And the good news is for 2024, we are expecting a further cool down of inflation, but nowhere closer to the 2% target that we are talking about. So US will still hit an inflation of about 2.8% according to IMF, and globally it will be about 5.8. These are still very elevated numbers to talk about, but not as bad as 2022 or 2023. So there is one good news, which is inflation is coming down. There is one bad news, which is economic growth also coming down. So that's the global economic outlook. So what about markets? Markets have rebounded very well in 2023 compared to 2022. 2022 has been a bear market, and 2023 has been a recovery market across the board, as we can see here. MSCI World, which encompasses all developed markets, is up 16% for the year so far, and the S&P 500 is up nearly 18.5%. Those are very good numbers to look at. And Japan is also up to 26%. That's quite good. So when benchmarked with the developed markets, of course, emerging markets have not done that well, even though they fell as much like other markets in 2022. As you can see here, they fell 22%, but then they got up only about 2%. So there is a lot of catch up to do there. Thanks to China, which has been having its own set of problems, and we look that as one of the key risks shortly. But amidst this gloomy emerging market performance, India has been a shining star, I must say. Both in 2022 as well as 2023, our markets were up. From a sectoral point of view, while S&P 500 is technically up 18.5%, all of that is driven by just one sector, which is technology. As you can see in this graph, technology, which fell by 32% in 22, has now shot up nearly 40% in 23, followed by cyclicals and industrials. And the most volatile sector happens to be energy. On the back of increasing oil price in 2022, energy performed very well, but they performed flat in 2023. And disappointing performance, I must say, comes from financials, which you should read it as banks. Banks fell minus 8.8% in 22, and they just got up 9.6%. Now, there is a trouble here. The trouble is when you say S&P 500 has increased by 18.5%, it's not a broad-based increase. It's just propelled by Super 7, as they call. And those Super 7 are Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Facebook or Meta. So if you combine the performance of these Super 7, and if you exclude them from S&P 500, so the rest of the 493 stocks in S&P 500 have not done well at all. So the biggest performance sprues came from these stocks. And just to explain contextually how powerful this is, currently the market cap of these 7 stocks is equivalent to the market cap of these countries like Japan, UK, China, France, and Canada. So that's the skew that we observe in the market. Is that good or bad? Will this technology rise continue? What is propelling all of it? Can that be sustained is the biggest question. If that's not sustained, then what will happen to broader markets globally is something that we need to worry about. That's on the equities market, but we also have the fixed income market to look at, and that's where the action is, because in response to containing inflation, the Federal Reserve has been increasing interest rates quite aggressively throughout 2023. And here is a table that gives you the rates, treasury yields starting from the lowest 1 month to the highest 30-year. And we can see how significantly these interest rates have climbed in the last 1 year. And that is primarily aimed to contain inflation. So when interest rates move up, the prices crash in the fixed income market, and therefore technically you will make a loss. So this increase in the interest rates actually started in 2022. That's why you will see all the fixed income in the treasury performance has been negative in 2022. But in 2023, they have been positive on the short end of the tenor, but on the longer end of the tenor, they're still making huge losses. And with respect to alternative asset class, which includes real estate, hedge funds, and commodities and private equity, it's been a very mixed bag. In the sense, the REITs is the proxy for tradable real estate in the market, and they had a very bad 2022, but a flat 2023, which means they haven't recovered. But hedge funds have recovered smartly, thanks to the long short strategies that they follow. Commodities have been disappointing in 2023, mainly on the back of oil. And private equity, which is a very which is quite closely related to public equities, but has their own differences, but still they have done very well both in 22 as well as 23. On the commodity side, what has surprised analysts is the strong performance of gold. As we can see here, gold is up 11% for the year and has breached $2,000 mark. And then we have oil. Oil has actually done well in 2022, but in 23 it's down minus 13.5%. A barrel of oil is now costing $74. At one point it went up to 95. And then one other story is the currency, and we'll shortly see what's the story there. And among the volatile asset class, Bitcoin has the best performance so far. It's close to 43,000 USD. At one point, it reached 60,000 in its life. It also fell to 10,000. That's in 2022. So you can imagine the plight of an investor in Bitcoin when he has to handle that sort of a volatility between $10,000 to $43,000 to $60,000. So that's the wrap up on equities and other asset classes. So now we'll move to the main core presentation, which is to really guess what would be the key risks moving into 2024. There are 5 risks that I will focus. Number 1 would be interest rates. They are very high, but the question is, will they go even higher or will they go down? That's one assessment we need to make. Then regarding the dollar, dollar has been extremely strong for the last few years. So will it give in and start depreciating? That's another question. The third most important question is the geopolitical risks. Earlier we had just one war, which is Russia and Ukraine. Now we have 2 wars, Russia, Ukraine, and Israel-Hamas. So will there be a third war, or will Israel-Hamas war spill into the larger region? These are the questions. And obviously, if that happens, what impact does that produce for the markets? And the fourth important risk is the oil price. Oil exporters versus oil importers. The Gulf countries are, they benefit when oil prices go up, but oil importers like India will be seriously hurt if oil price goes beyond a certain threshold limit. So let's do some assessment there. And finally, the elephant in the room, as I call the China, what is going to happen and how that economy is going to fare. The beauty of these 5 factors is that they were all there in 2023. They are not new, but they may just change in flavor in 2024 and 25. So pretty much these risks are what I call as known unknowns. So they are not unknown unknowns. So they're pretty much on the top of the mind for analysts, and but the thing is, it still warrants a closer look in terms of what we need to do. So let's first take the interest rate, because this is the toughest thing to crack. Now, we know that Fed has been increasing interest rates very aggressively in 2023, so much so that the interest rate used to be almost 0% for nearly a decade. And then from 0%, now it has touched 5%. Now, that's a very, very sharp increase for a very developed market like US. You don't see this sort of interest rate movement in a developed market like US, but thanks to high inflation, they had no other choice but to do this. So now, last November meeting, FOMC skipped another increase, and people widely read that to be a signal to the market that interest rates have peaked. So when interest rates have peaked, now we need to see when it will start going down. And that's what in economic terms we call it as pivot. So where the word pivot refers to interest rates starting moving downwards. So the guess is, now we have to guess when interest rates will pivot. Now that will depend on three major parameters. Number one would be inflation. Obviously, if inflation goes up, interest rate goes up. And number two would be economic growth. Obviously, if interest rate goes up, economic growth goes down. And the third and most important thing is the labor market strength, which is measured by unemployment rate and jobless claims and what have you. So if inflation continues to be very high and economic growth also continues to be very high, and with a very strong labor market, then Fed will not be incentivized or encouraged to reduce interest rates. But if inflation moderates a bit and economic growth continues to be strong with labor market, then there is a small chance that Fed will start reducing the rates. But the scenario in which Fed will reduce for sure would be when interest rate really comes down, economic growth also comes down, and labor market also relaxes a bit. That's when you will see the Fed reducing the interest rates. So how do we convert this framework into some numbers is what I've done here. And I call them as three scenarios across three time periods. So time periods would be middle of 2024, end of 2024, and end of 2025. And the scenarios would be, the first scenario is when inflation moderates and we encounter a recession, which is mild, not too big, and then we continue to have a very tight labor market. That's when we are expecting Fed to deliver a 50 bips reduction in interest rates by the middle of 2024, followed by another 50 bips by the end of 2024, followed by another 100 bips by the end of 2025. As you can see here, the current 10-year yield is about 4.12%, and a 50 bips reduction consecutively 2 times, followed by 100, will take the interest rates to about 2.12 by the end of 2025. Scenario 2 is instead of moderate inflation, we have actually a low inflation, but we don't have a recession, but the labor market, instead of being very tight, continues to be moderate. In that case, Fed will be enthused to deliver a larger interest rate cut, not 50 basis points, but 75 basis points. And in scenario 3, where inflation continues to run very low, but economic growth continues very high and labor market slackens a lot, then Fed will be really pushed to deliver the maximum reduction in interest rates, which can be between 100 bips in middle of 2024, another 100 by end of 2024, and 150 bips by 2025. So practically the rates will come to 0.62, the rate which we have been used to for more than a decade. So those are the scenarios. And obviously, the probability for scenario 3 is only 20% in my assessment, with a 40% probability for scenario 1 and 40% probability for scenario 2. So this is how analysts work. They work on probabilities and scenarios, and it's a nice way of sizing a problem. Instead of giving one point of view on what is likely to happen, which mostly may not happen. Let's move that discussion to currency, because USD performance is key for emerging markets like India as well. Because remember, any index has two varieties. One is a local currency index and a foreign currency, which is USD index. Can also be Euro index, Yen index, or whatever, but most followed is the USD index. Now, if stock market in India goes up, but rupee falls, then a foreign investor doesn't make any money. So from a foreign investor perspective, performance of dollar is a key element for investment decision making. And that's why this is a key risk for all of us. Now, how the dollar will perform is a question of how it has performed in the past. In the past, if you look from 2014 all the way to 2023, dollar has been extremely strong for many years, except for 2017 and 20. Now, will that strength continue, and or will dollar start weakening is the question. Now, that strength will continue if a Fed delays the rate cuts and holds on to the high rate for a longer time. And then you also see a rebound in the US economy or higher inflation. All this will definitely keep the dollar stronger. But currently, economists think that those are not likely to happen. What is likely to happen is inflation will ease, and the Fed will reduce the rates, and definitely the high rates that has already been delivered will slow down the US economy, as we have seen in the IMF numbers. And therefore, all roads point to a weaker USD for 2024 than a stronger USD. And if you look at the calls made by investment banks like Goldman Sachs or Morgan Stanley or UBS, they're also saying the same in terms of their call for currency. So that's where we are now in terms of dollar. The next risk would be oil, because oil is so crucial for our current account deficit, and it can upset a lot of plans if oil goes beyond control. So if you historically look at oil price movements from 2017, we can see that it range bound for a very long time between $20 to $60, and then it broke and moved into a higher plane, and now it's hovering between 75 to 95. So that's the story. And the call in terms of oil price by agencies like International Energy Agency, which is being widely followed for oil, plus the investment banks and credit rating agencies, all of them are aiming for a $75 oil price, which is a very palatable number for a consumer like India. But what controls the oil price? It's a play between demand and supply, like any other product. So while demand is expected to come down because there is a global slowdown that we are expecting, plus the Chinese slowdown, all that will bring down the demand. So the OPEC cartel, they are called as OPEC Plus, and OPEC mainly includes Saudi Arabia, Kuwait, United Arab Emirates, and Plus refers to Russia. So together, the OPEC tries to compensate the fall in the demand by reducing their supply. So they have significantly reduced their supply in 2023, and that is what is actually keeping the oil price afloat as at the current level. And another factor that probably is can increase oil price would be the geopolitical risks. We have seen that happen when Russia-Ukraine war unfolded, and now we have a Hamas-Israel war, which is right in the Middle East region. And so that's a big question mark for oil. So when this war escalates beyond imagination, then oil price will shoot up. We'll shortly see how much. And then on the negative side, which can reduce the oil prices, the demand slowdown, as I have explained, and more importantly, the non-OPEC production. Oil production is divided between OPEC and non-OPEC, and OPEC is led by Saudi Arabia and Russia, and non-OPEC is mainly led by USA. And whatever OPEC Plus has pulled out of the market, we can see in this graph, non-OPEC has pulled into the market. So while OPEC pulled out 3.6 million barrels a day, non-OPEC, mainly US, added 5.6. And that's what is keeping the supply or oil market well supplied. So if oil market is not well supplied, then you will see a big spike in oil price. So US is trying its level best to keep the oil market well supplied. On the other hand, we have also a question as to how long our dependency on fossil fuels meaning oil, coal, and natural gas, how long the world will have to depend on these fossil fuels, which are not very climate friendly and which is very pollutive in nature. And as we know, the world is moving towards renewable energy and electric vehicle, clean energy, and what have you. But how quick that transition is, and that will also tell us how the oil price will be shaped. Now, while there is a lot of talk about the shift that is happening to what we call as unconventional energy, but the world still depends to a very large extent on these fossil fuels, which is coal, oil, and gas. India especially depends on coal to a very great extent. So that takes us to the next risk, which is China. China is a huge country. It's our neighbor, and it has been a global growth engine for several decades, as we know. So Chinese growth is basically an export-led growth. If you look at US growth is always a consumption-driven growth, whereas Chinese growth is very export-led. So when exports start falling for China, GDP growth also falls. And that's what we see in this graph since 2015. And if you look at 2024, UBS made a call that the global growth will fall from 3.1% to 2.6%. And that fall is mainly orchestrated by Chinese fall, which is nearly 0.24% in that. So China is a huge contributor to the fall of global growth. So China is doing everything to pep up their economy. They've made some blunders, like they overreacted to COVID. They imposed lockdowns, and they refused to lift it. And they allowed the property sector to lay in tantrums for a very long time. And they are also piling up debt. So all plus they don't have export growth. So a combination of many of these things have led to Chinese GDP growth firing far below its potential. At one point of time, China used to grow at the rate of 10%, and now it is growing at the rate of 4%. So we can imagine what a fall they have experienced. So in order to stem the rot, Chinese have announced a huge monetary policy accommodation, a 1 trillion yuan debt plan, a lot of stimulus plan to revive the property sector. They're doing whatever they can to really get there, but it's not happening. And most of the outlook for China for 2024 is somewhat bleak compared to other markets, especially compared to India, which is expected to grow very, very strongly. So geopolitics, as I will already explained, we don't have one but two wars to look at today. And in the past, whenever war-related oil disruptions happened, markets reacted very violently shortly after the war. And sometimes these wars lasted for a very long time, like the Iranian Revolution, and sometimes it was very quick and swift. But in all the past cases, there was a reaction to global geopolitical developments. But this time around, the Israel-Hamas war neither produced any impact on the global markets nor on the oil price. And many wondered as to what could be the reason for this. The reason is the oil intensity for the world has really come down, and therefore markets are not too bothered about it. But there is a World Bank study recently which says that if the war spreads beyond the region, and if that results in some supply disruptions, then that will definitely result in oil price spikes. So the question is how much supply disruption, and therefore how much is the oil price increase? So up to 2 million barrels a day, if supply is disrupted, we can expect oil price to move to about $100. If the disruption is between 3 to 5 million barrels a day, then we are talking about 120. But if the disruption is about 6 to 8 million barrels a day, then we are talking about an oil price of 150 plus. And today at 75, 150 means doubling of oil price. And we can imagine what type of a deficit that can bring to a country like India. So with those key risks covered, I'll just quickly touch point India, but very briefly from whatever little knowledge I have on Indian markets. One thing I know for sure that China is the biggest market in the emerging market basket. The emerging market basket has about 30 plus countries, and China has a huge weight there. We have other markets like Korea and Brazil and Russia and India. Indian share has been going up off late, but nowhere closer to China. But what analysts would be keen to know is the performance. So $100 that one invests in China and India back in 2018, you would have seen that reduced to $85 for China, but $170 for India. So long term, Indian markets have done well. But if you look at this chart very closely, from 2018 to 2021, India has been underperforming China, and then the breakout happened. And Chinese started going down, and the Indian markets started moving up. And that's when the real performance differentials started emerging. And now it is the widest performance differential to notice. Case for India depends on many things. For example, Indian GDP growth at 6.2% seems to be peaking according to many analysts, and may go back to sub 6% levels over the next 2 years. This is because we expect fiscal impetus to fall, and also primarily on the back of global weakness that we have discussed in detail. Our external position, what they call as Trinity, Forex reserves, BOP, and current account deficit, they remain very comfortable. Forex reserves is one of the at its highest position. So we have a lot of dollars to defend the currency. And our balance of payments also is reasonably okay on the back of tolerable oil price. But if oil price really goes out of hand, as I've explained, the balance of payment position also can become very critical. Indian economy doesn't operate in isolation. It operates in a global ecosystem where what is happening in US is also equally important for us to understand, because it might have ripple effects to consider. And the whole problem started when COVID came in, and to combat the pandemic, US government increased the spending considerably. So much so that their fiscal deficit widened from 3% to 10%, very unheard of numbers. And not only that, they have significantly expanded their balance sheets just from 1 to 2 trillion to nearly 4 trillion. And they kept the interest rates at zero for a very long time. And then we had this easy fiscal and monetary policy over the last 3-5 years led to very strong growth and inflation. And then to combat that, Federal Reserve increased interest rates by 500 bips. And also they reduced the balance sheet from 3 trillion to 1 trillion. Now, reducing the balance sheet is also a way of actually increasing the interest rates. So the call on India is that unless we see a large depreciation on the rupee or a higher outflow, we don't expect the central bank to really raise interest rates. So in line with what Fed is expected to do, RBI is also expected to not follow one-on-one, but broadly that would be the trend. There are definitely positives for India. The most important is happening on the fixed income side, because JP Morgan has finally, after years of lobbying, has included Indian sovereign bonds in their index. And that one action from JP Morgan is going to bring in about $25 billion in the next 12 to 18 months, which will be very, very highly favorable for the demand supply for bonds. Well, the macro story looks so far so good, but there are always risks, and that risk would be the increasing crude oil price, and that's why I spent a lot of time explaining oil. And the second risk is China, and that is also we have spent some time understanding what is happening to China, and maybe there is a possibility that China would be pushed to devalue its own currency to attract flows, and in that case, people will take money out of India and then pour back to China. So that's a very big risk to look at. So with that, I will move to my last theme. What I have presented as 5 key challenges or risks all pertain to 2024. But as analysts, it's very good to think beyond 2024. Because they might also have investment implications in a very big form. Many themes are emerging of late, and for example, climate change. Recently, we have a COP meeting in Dubai where 190 plus countries have attended, including our Prime Minister. So there is a lot of pressure from developed markets on emerging markets to reduce pollution, carbon emission, and what have you, because world is getting hotter as we speak, which leads to very erratic behavior of weather, and that can cause huge destruction to many economies and sectors. So climate change has emerged to be a big theme, and that will favor some sectors and disfavor some sectors. Similarly, demographic change. Demography is a great topic to research. How people evolve as a cohort is very important to understand. There are some economies like Japan that is getting old. There are some economies like Nigeria, which is very young. And there are some economies like China and India, which are in the middle. So when people generally go through this, then the composition of working age population changes, the composition of people who are dependent changes, and the composition of social security expenses changes, and therefore that produces some opportunities in some sectors and again lack of opportunities in other sectors. Energy transition, we have seen how world is dependent on fossil fuels for a very long time on a very big measure. And now we are seeing the energy transition to clean energy. We are noticing a lot of electric vehicles hitting the roads. And that's a topic, again, that can unveil a lot of opportunities. World economies are also piling up on debt thanks to US, which is showing us the way. A lot of countries are accumulating debt beyond their capabilities, not even beyond their capabilities, but beyond the capability of some few generations to come. And how will this play out? Because if debt keeps increasing to unsustainable level, then interest will become a very large portion of your expenses. And that will give you smaller room to spend money on infrastructure and what have you. So that's a big thing to look at. Post-COVID, I think the world has become very deglobalized, and countries have started looking inward, including India, because now the mantra in India is make in India is nothing but deglobalization. And if everyone says that I want to make it myself, then there is no trade that can happen. And that's a very big theme that we need to focus on. Cyber threats, we know how it keeps coming and haunting many companies and economies. So many central banks have been robbed millions of dollars through hacking and what have you. That's a big risk. Where will it come next and how it will come is a guess. And the information technology is going through a huge transition in terms of emergence of artificial intelligence and metaverse economy. It changes the way we work, it changes the way we think, it changes the way we produce and sell. So world will be a very different place with these tools coming in place. A related topic to demography would be healthcare. While people are getting old, they're also getting obese, and therefore obesity related healthcare impact will favor some sectors and will disfavor some sectors. We are all addicted to social media. We know that, we have observed that we are also a victim ourselves. So that can have profound implications on productivity. So when organizations suffer productivity loss, then that will impact their margins. So all these themes at the first look, it may look very theoretical, but at a closer look, it might have portfolio implications and investment implications. So that's the theme and thought that I want to leave you with. Though my idea is just to present risks for 2024, I also wanted to show you how these themes can produce outsized opportunities if we have the time to go and research them properly. So with that, I will conclude my presentation. Thank you for a very patient listening, and happy
Thank you,
to
sir.
take,
Thank you very much. I think it's a huge canvas, a very studious and detailed look into the number-based sensitivity analysis of the 5 big parameters that are going to shape 2024, especially the risk factors. And also you have touched upon the big 10 factors that are going to influence us. Thank you so much for putting everything together for us to consume. It is very difficult to do this presentation in 20 minutes, which was the original plan generally we allocate for opening remarks. But yes, you have detailed it out, and therefore there are numerous questions. We would like to take a few questions at least out of that big list. But before that, I want to once again thank all the members who are present here. Today we are joined by distinguished academics, technologists, people from media, and people from a social sciences background as well, additive manufacturing background. I think people from all cities in India have joined. I welcome you all once again, and I'm sure we're going to have a meaningful conversation from here as well. I request Professor Prasad to start the cluster number 1 for the questions. We may perhaps be able to take a couple of questions in the cluster 1. I'll come back for cluster 2, and I'll open the mic for others who are raising hand. Maybe we'll take a couple of questions there as well. Professor Prasad, thank you.
Thank you, Professor Rao. Thank you, sir, for opening up the canvas and illustrating the risks which are relevant as well as those which are going to come, the themes which are going to come. So I'll come straight to my first question, and this is a very basic question. We have used the word risk. In the last slide, we've used the word theme. So how do you distinguish somewhere else, how do you distinguish risk from threats or themes? And how do you categorize something as a key risk? So a very fundamental question for people who don't understand this as much.
Yeah, very good question. In the investment banking world or asset management world where I work, we always look at risks as opportunities. So we don't, of course, it's a threat, but how do we take advantage of the threat is the question. For example, let's take interest rates as a risk. Now, if as an economist or as an analyst, I make the call on when interest rates will peak and when they will fall, then I see it as an opportunity, because when yields start falling, then bond prices increase and you make a lot of money. So but the call on when it will fall and by how much it will fall is very important. So every risk that I presented here is, of course, if you don't manage them, then it's a threat. But if you manage them, then it's an opportunity.
Thank you, sir, for simplifying it and putting it across. The next question is about you have spent a lot of time studying risks. Now, as a non-finance manager, how does one go about risk identification and assessment in outline terms?
Well, in non-financial terms, I think the risk will primarily fall into an operational perspective. So if you are a sales manager or if you are a plant manager, you need to worry about the risk from that perspective. For example, how much sales fall I can expect if cost of money is going to continue to be very high, or if how much of an increase in sales will be accounted by inflation rather than organic growth in the number of units sold. So it's not a risk is not very silo study in my view. Of course, all the risks will finally translate into finance, okay, in terms of how it affects the top line and the bottom line. But at a departmental level, everybody will have to contend with the risk analysis as much as a financial risk person. HR, for example, for them the key risk is attrition. So based on how the view of the economy is going to transpire, they may have to make a guess on what type of an attrition rate they have to forecast, and therefore how prepared they must be to encounter that sort of a scenario. So risk actually cuts across several functions, and of course each function will talk about risk in their own language. But finally, what will happen is everything will get converted to finance, and then you will see the impact in terms of top line and bottom line. So that's what, as financial risk managers, we do. We neither produce this risk nor we manage this risk. We only analyze this risk and warn them about their impact on the financials and therefore the stock price. So that's how we see it, actually.
Excellent, sir. When companies manage risk, they go about doing it in different ways. So what are the factors which influence this behavior? Can you give us a use case which helps us to understand how this is done? I mean, how it is differentiated?
Yeah, two things. One is being reactive and being proactive. So this is how it should be. For example, if you are a CFO of a company, and your job is basically to estimate the liquidity requirements and plan for filling up that gap. So if you have a huge project coming up and you can break down your liquidity requirements into working capital and capex, and then you need X crores of rupees to navigate 2024. Now the call is, what is the avenue in which you're going to tap? It can be equities, it can be bonds, or it can be loans. You are the treasury guy and you will take that call, but you will also take the most important call as to when to press the button. Because if you expect the interest rates to fall in the next 6 months, then you will keep quiet now and press the button only 6 months from now when you expect the interest rates to come down. And but if you don't expect the interest rates to come down at all for the next 2 years, then you're better off pressing the button now, actually. So that's the use case that one can imagine. This is just one use case of a CFO trying to plan his liquidity based on his forecast of interest rates. So you see how economic forecast comes into business decision making. This is very important to understand. And we have several such use cases that we can think about in terms of converting risk assessment to forecast and then using that for business decision making.
Thank you, sir, for highlighting how important it is, and whether one understands the function or not, the role of a CFO in such a situation is going to be extremely important.
Good.
The last question is cluster, sir, before I hand it over. And this is, you have introduced the theme of artificial intelligence as a theme for beyond 2024. What are the risks for traditional economy, for the traditional economy you perceive from artificial intelligence ramp up? And what suggestions would you give for mitigation?
The biggest risk would be job losses, because what men can do, now machines can do. So that's what artificial intelligence is all about. So there will be, a lot of job losses in traditional industries as AI takes over many of the processes. But there will also be job demands for AI-related work, actually. So while the problem is they may not synchronize that well, and there might be a lot of gap between job losses and job gains, and that is where people have to be very clear about the impact. Now, AI will impact certain industries much more than others. So if you are employed in those industries, then you need to quickly upskill yourself before you become irrelevant. And for example, AI's impact in asset management is not that high compared to, say, AI's impact in hospitality industry. So if you are an asset manager, you can worry about AI, but you don't have to lose your sleep. But if you are in the hospitality industry, you better wake up and upskill yourself, because you know that the tsunami of AI is going to come and hit you hard in the next 1 or 2 years before you realize, actually. So that's how I would think about it.
Excellent, sir. I think you've also given us some inputs in terms of careers for those who are looking at doing something in AI, as well as those who need to be careful about where they're going to get hit. Thank you very much, sir, for the wonderful responses. I hand it back to Professor Rao.
Thank you, sir. I've been watching your responses. Very interesting, very useful to all the members around the screen this evening. It is made simple on one hand. At the same time, there is an evidence-backed, data-backed forecasting and your own view that you have mentioned for the year 2024 that we should watch out for these risks. I will quickly. There's a challenge for me now in terms of time. Therefore, the risk that I will have to mitigate is by lowering my own questions and allowing others questions, especially those who have raised their hand. So I'll go for allowing them to talk first. There are very interesting questions. Just in case they don't raise, I will come back, sir. Kritik Memori. Yes.
Thank you, Mr. Sudhakar. Thank you, Mr. Raghu, for allowing me to ask my question. My question is regarding the recent Russo-Ukrainian conflict. I'm curious how it may impact India due to the fact that India gets the majority of its oil from Russia, and Russia's economy may suffer from the Ukrainian conflict when especially focusing on the amount of weapons they have. They're running out of have many of their sophisticated weaponry, as well as having to utilize antiquated technology and import weapons from countries such as North Korea and Iran. So what do you think the Russo-Ukrainian conflict has in terms of impact on the Indian economy?
Well, I must say that I'm not a political analyst, so I have no idea how this is going to transpire. But one thing I can tell you is that when Russian-Ukraine conflict started, many thought that it will be a swift and quick war. But the Russians came to the table with a very different idea. They wanted to tire the opponent by making it as prolonged as possible. So that's what I have observed. And initially, a lot of concerns were there about this war, but now it looks like it's settled down into just a conflict between Russia and Ukraine. And we have supporters for Ukraine, we have supporters for Russia, and that's how it is placed currently now. NATO is on the opposite side along with the US, and they're not going to give up that easily. Nor will Russia will give up that easily, because Russia is supported by China and others. And therefore, it can prolong as much as both the parties want. But the question is, your question is how it will impact India. Of course, so far, it has impacted India positively, because Russia has been selling oil at a cheaper price to India, and India took very good advantage of that. But that will not continue forever. And at some stage, India will have to shed their neutrality and should say where they belong. Do they belong this side or that side? But that's only in case where the war takes a very ugly turn. And in my view, it will not take an ugly turn, because if it would have taken an ugly turn, it would have taken an ugly turn by now. So since it is not, it will just be a prolonged war between Russia and Ukraine, and India will be very happy to buy discounted Russian oil for as much as possible because it will directly benefit us. Other than that, the political dimensions, I don't know because I am not a political analyst.
All right, thank you, Mr. Raghu. And to further extend on my previous question, because of India's over-reliance on Russia's oil, do you think a similar incident to the Nord Stream pipeline incidents may happen, since it's theorized that the Nord Stream incidents were a result of intentional sabotage by other countries? So do you think something similar may happen to the oil pipelines between Russia and India in the near future due to India's neutrality with Russia and so far no specific allegiance towards any party?
That's a very good question. Of late, ever since this Russian-Ukraine war started, India's dependence on Russian oil has increased manifold. Now, obviously, that is at the cost of the traditional oil importers for India, like Saudi Arabia or Qatar or Kuwait, whatever. So now, remember, this transition from traditional oil suppliers to India to Russia is not at the risk of annihilating these traditional oil suppliers. With all the traditional oil suppliers, India enjoys a huge advantage of very good bilateral relations. So if something has to go wrong with Russia, it will not be very difficult for India to move back to those traditional suppliers who have been supplying oil to us for decades. So I'm not seeing this as a problem. I'm seeing it as let it play out as long as it can, and let's enjoy the benefit of cheap oil. Moment it stops for some reason, we can always revert back to the traditional OPEC plus group. And OPEC plus is also sitting on a huge spare capacity. So not being able to supply to India is not a situation that will arise at all in the near future.
All right, thank you very much, Mr. Raghu. Your answer to my questions have been quite insightful, and I hope you have a nice day.
Thank you.
Can we have the next person, Anup Singh? Can you
Okay,
please
good
raise
evening.
your question? Yeah, who's
Good evening,
that?
sir. This is Manisha, sir. Manisha,
Please go
Prem.
ahead. Please go ahead.
Good evening, sir. Thank you for a great presentation. It covered all the intricacies of risk management. I want to ask a question regarding your place, Middle East, which covers most of the Indian NRIs. So I want to know what should be their investment behavior with the type of canvas you have provided to us in the war time or in the coming time. What should be their investment behavior?
In our observation, Indian NRIs as a group are not like a typical investor from Middle East. If you take a typical investor from Middle East, like for example, a Kuwaiti or a Saudi, they always have a global portfolio managed by global investment banks for them.
Yes, right.
But when it comes to Indian NRIs link to the Gulf is only to generate income from the Gulf. But when it comes to investing, most of the money is channeled back to India. So either in equities or in real estate or in bonds. So you can see that their global exposure to markets is very limited because of the familiarity that they enjoy with India. And they know what to buy in India. They have their financial advisors in India, and they're very, very heavy on real estate in India. So for them, the element of global markets do not come as much as a typical Middle East investor that we normally work with, actually. So even in our client base, you will see that we don't have too many NRI Indians as our clients.
So there's one more question I want to ask. Like you have talked about the job insecurities.
Mhm.
Like all of the Middle East countries have their vision statements where they do not include any of the expats, whether it is from West or from any other country. So regarding that, what the risk management which you have spread across, what could be done about it as a government of India or any other country?
Yeah, from a Middle East perspective, they are going through two aspects. One is they have a huge problem of expats crowding out locals from an employment perspective. And the secondly, their dependency on oil is so high that they want to break away from that and diversify their economy into a knowledge economy. So the first aspect, as I said, huge presence of expats crowding out the locals is a very big problem. For example, in Kuwait, 80% of the population are expats. In Qatar, 95% of the population are expats. In UAE, it's even higher, 96 or 97% of the population are expats. So when you have this much of expat population, you can imagine how the providing employment to local nationals will become a huge challenge for the government. So they're trying to reduce that dependency on expats, but they're also trying to reduce the dependency on oil. And that will happen only if you transition to knowledge economy, which again requires more expats to come and help you there actually. So they're caught in this, I would say, conundrum. And therefore, this will be like this for many years to come, actually, because one balances out the other. So it won't be a very clear one direction that it will take off, actually. So some sectors will open up for opportunities in the Middle East and others will get closed.
Good, sir.
Great.
Thank you very much for
Thank
the
you.
answer.
Thank you. I'll request Raghuvaran, my colleague, to open the mic for all the three of them who are raising their hands. In the meantime, I'll take one question, sir. And that is, what will be the journey of cryptos after a tumultuous year in 2023?
23 has been a great year. Whoever has invested in crypto is now laughing all the way to the bank. But crypto is a speculative asset class and a volatile asset class. And it is facing a lot of pushback from central banks, including RBI. So while it was mainly invented as a very secured way of conducting transactions through blockchain technology, but it now looks like there are other, use cases of blockchain that will come and probably dethrone crypto from its asset class status. For example, central bank digital assets is a huge project that everyone is coming up with. So blockchain is the technology. Crypto is a derivative of that. And so far, crypto is very popular because it's very speculative, volatile, and can yield good profits as well as incur huge losses. So I feel that it will continue to be a very volatile and speculative asset class, mainly dealt by high net worth individuals who can afford to take that sort of a risk. But I don't think it will become a mainstream investment play for normal investors like you and me, who will not risk our hard-earned money in speculative assets.
Thank you, sir. So it will remain volatile, although it's not a mainstream asset that we should worry about. The other question quickly I will take before Professor Shantanu raises his hand. This is a lot of commentary on India having 2024 as the election year, and therefore volatility in the Indian stock market during these election periods or election years is expected. What is your outlook, and what are the things that we should actually worry about in such a scenario? I think elections are going to be there around May 2024. So what are the 2-3 things that we should bear in mind?
Elections are like wars. As I said, I've shown one slide about what happened to all the wars and how markets reacted to the wars. So election is a very short-termish impact for markets. If the outcome is on expected lines, the markets will celebrate for some time before it settles back. If it is on unexpected lines, again, the markets will dip before again it settles back. Because the only thing that the market will react finally is on the economic strength and the corporate earnings. That is not going to change significantly just by election results. You sow the seed today, you reap the benefit 5 years from now in terms of infrastructure or what have you. So economy moving is a very long-term thing. Corporate profits are also based on capex, which has got cycles. And therefore, just one election will not change the economic picture or corporate profit picture drastically. But it will, around the election time, maybe a month before and a month later, you will see a lot of excitement, volatility, analysis, narratives spun around it. But I think after that, it will quickly settle down to what really matters for stock markets, which is corporate earnings, actually.
Thank you, sir. So the economic forecast is dependent on the business cycles, which are actually long term. And of course, the short-term excitement could be there because of election, because stakes are pretty high. But the results of those decisions or outcomes will be felt over a period of time. Thank you, sir. I'll request Professor Shantanu to raise his question.
Yeah, thank you, sir. And I agree with Professor Raghu because what he said, like I've been in UAE for close to 9 years, and he was mentioning about this blockchain platform for banks. So yeah, when this thing like R3 Coda platform for international banks, there are about 29 international banks now, and Marco Polo is an initiative they are proposing. So yes, blockchain is not just confined to crypto. Now it is like encompassing international trade in a large extent. My question is, UAE as a host of COP28 summit, has announced $30 billion climate investment vehicle called Altera, and it's the world's largest private investment vehicle for climate change action. Now, what is interesting is, out of this investment, investment has been earmarked for the development of over 6 gigawatt of clean energy capacity in India, including the construction of 1.2 gigawatt of wind and solar projects set to start generation by 2025. Now, the UAE-India collaborations are actually expanding in many fields, and climate change is one area, and COP28 that is being hosted at Dubai is one initiative where these two countries are coming close like never before. So, what do you think is the foresight? Like since I've worked there and I've seen the changes from 2012 to 2020 when I left, end of 2020, there was a huge change, and you have very correctly said, like it has changed metamorphosis. When I entered Dubai in 2012, Indians were looked at a different way. When I left, it was very, very different. So yes, Indians are now looked at. I mean, it's not just UAE. I think many parts of the world, when you travel as an Indian, the response even at the counter, custom counter is observed is very different. So what do you think as this climate change and all, because COP28, UAE is the host and they're taking, and of course, they're taking so many initiatives as one of the countries. So in future of that, so, and India is actually a partner in that initiative launched by UAE. So your comments on that, sir?
Sure, thank you. I've already touched on the climate change as one of the 10 themes towards the end. Climate change, now we are at a realization phase. And then this realization phase should transform into policy making phase. And then the policy making phase will transform into implementation phase. So I see 3 distinct phases in climate change issue, and we are still in a realization phase, in my view. What is the realization? The realization is the world is getting 1.5 degree to 2 degrees hotter. And therefore, that is unleashing some erratic behavior in terms of weather. And that is affecting economies and monsoons and production and what have you. So that is the realization phase. It took about 5 to 10 years for the world to realize that they are staring at a real problem and not an artificial problem. So now the conclave in Dubai after the France conclave that happened before that is just to move it from realization phase to a policy making phase. The biggest tussle in the climate change problem is that there was a period from 1900 to 1960 when today's developed economies have contributed to the overall pollution very, very big time. That includes US, that includes Europe, that includes UK, everyone. And now their contribution has come down, and emerging markets contribution like China and India has increased. Now, now that the topic of climate change has come now there is a request that China and India should stop using coal and should stop using fossil fuels and should start pushing the clean energy drive. But there is a cost associated with that. So emerging markets are saying that you guys have first polluted the world, So now you first pay compensation for that before we move on to this. So this is the tussle that will happen between early contributors of pollution and current contributors of pollution. So now that has to be settled through policies. So that is phase 2. And then once the policy is settled, some mitigation fund is formed and some rules are emerging as to how much you can emit, how much you cannot emit, what type of subsidies that we should launch to encourage EV adoption and what have you. Then we'll move to the implementation phase. So I don't see this happening in 2024 because that's why I didn't flag that as a risk for 2024. This is a decade-long work that will happen in stages with so much negotiations at play. So we need to wait patiently for this to evolve into some meaningful, efforts from almost all countries in the world.
Thank you, sir. Thank you.
Thank you, sir. Thank you. That was a very, very interesting question as well. Sir, we'll quickly take the question from Mr. Bibu Mahapatra.
Good evening, sir. I have two questions I observed from your presentation. One is like India is doing like GDP growth is high. Same time, the inflation is also high as compared to the other countries. So how does it have the impact in long run? Second question, if you see the China and India, China market is mainly based on the export-oriented market. India is also focusing on manufacturing segment. So a lot of investment is coming to India in manufacturing, especially if you see the electronic segment and as well as the technology segment. So, but in China, majorly the market, they give a lot of subsidy. So how does it have the impact on Indian economy? Like when they make manufacture a lot of products, is it internal consumption or it is export oriented? How does it have the impact?
As I said, I'm not an Indian expert. I try to answer as much as I know. Yeah, the relation between GDP and inflation, that's a known relationship. A typical emerging market like India, inflation levels close to what we are next. The relationship between GDP and inflation is a very interesting one. That's why we have something called as nominal GDP and real GDP. The focus is always on real because nominal minus inflation is a real GDP. And moment inflation becomes more than nominal GDP, that's when you'll have negative real GDP to contend with actually. So RBI will keep a very close watch on real GDP not turning negative. And if it does turn negative, then RBI will accelerate interest rates very quickly to put that equation back in order. Regarding China, China, of course, has been an export-led economy for a very long time, thanks to its huge subsidy program and almost selling everything for free. So that's what is hurting them now. And that is why you see that they are in big trouble at a very broader economic level. Secondly, from the Chinese problem converting into Indian opportunity, it is called as China plus one type of a policy because when COVID came, world realized that, depending China on supply chain is a huge risk going forward. So they wanted to be in China, but they also want to have China plus one. And there are many countries that are vying to this spot of plus one, which includes India, Vietnam, for example. So while a multinational company will definitely look at India as a plus one opportunity to set up another supply chain base, just to be sure that they're not caught like how they were caught during COVID. But that's easier said than done. Of course, we have seen big headlines like Apple and others coming and setting up shop here. Tesla is coming and a lot of people are coming. Made in India is a big slogan that we're doing. But remember, India is also a difficult place to do business. So it's not ranking very high on ease of doing business rankings. Bureaucracy, red tape, corruption, these are real on-ground problems that company faces on a daily basis to really operate in India. Of course, we have made huge progress during the last 1 decade in terms of minimizing or controlling this, but they have not gone away. They are still there. So when it comes to companies investing in India, I think it will be both a combination of local consumption plus export opportunities or re-export opportunities, as I would call. Why local consumption? Because it's a market that is bigger than China now in terms of population. Recently, we crossed the Chinese threshold of total population number, and India is now the largest populated country in the world. So that market you cannot ignore when you want to set up a base here. So that will be one. Secondly, the China plus one policy, those people who are coming with that China plus one policy will probably set up something in India to produce and export to other countries. So both opportunities are there, serving local consumption needs plus export. So it will be a good opportunity to seize, provided we fix our long-standing, nagging core problems that are typically present in any emerging market for that matter.
Thank you, sir.
Thank you, sir. Wonderful review of the opportunities that are lying ahead of us with respect to manufacturing in India and some of the challenges. Of course, the inflation will have to come down. Now, in the interest of time, what I will do is, Mrs. Samina was there asking questions, so we'll give her the first opportunity. Mr. Raghuvaran, can you help Mrs. Samina to ask the question?
Yes, sir.
Yeah, go ahead.
Good evening, sir.
Good evening.
Yes, sir. Relevant to the question only, sir. Just now you explained. But my point of view, that pharma industry is also developing, sir. Now, number one, in global way, India is coming into number one position, sir. So I think that layoff will also don't affect us, sir, when we are developing this pharma and agriculture, biotechnology. These things will support us, sir, in our economy also.
Yeah, for sure. But remember, our education system is not designed to produce people who are industry ready. So if there is a technology revolution that is happening in the pharma industry, then we need to also revolutionize, pharma graduates, how they are delivered in terms of the biggest problem for most of the economies in the world is the disconnect between what is being produced by the education industry and what is really required by the corporate world. So that friction will always be there. So while on the one side, India will experience hectic growth and export opportunities and what have you, on the other side, they will find it very, very difficult to get the right person for the right job. So that is again a long-term thing that has to play out. You have to go back to your school curriculum and see how to convert the syllabus into making people industry ready as soon as they step out of the colleges. I think Sudhakar and his company will know that problem much better than me. They are producing graduates every year.
Thank you, sir. This is not a problem that has emerged of late. This has been there for quite some time. And the skill gap or the gap between what is required by the industry and what can actually be taught in the educational institutions has to undergo a lot of change, and that gap has to be minimized. The courses that are taught are largely basic courses, but the rate of change is very fast in industry, and therefore that catch-up is remaining a forever catch-up. I think that is something which we have to work on and mitigate. We will also take one question from Anup, and I'll request Professor Prasad to come in and conclude after that. That is, I'll read out Anup Singh's question. What is the impact of all these 5 parameters of economic changes or the risks? How is it going to impact the e-commerce business, especially in terms of expansion of opportunities in MENA countries for sales? I think one is trying to understand the opportunities for sales in these countries, especially in the e-com sector.
That's a good question. Actually, the transition to e-com is very, very strong across the world. But the Middle East may not experience the same hectic growth as a typical market like India. Because of various reasons. Because in the Middle East, people would love to still walk into a mall and experience the benefit, the thrill of shopping, actually, especially among rich people. But in India, I think the savvy usage of mobile phones has triggered a huge, increase in the e-com, and therefore it will be. But in any case, we are talking, even at the minimum, we are talking about some excellent growth rates in e-com. So e-com is the trend, and we see not only e-com has been there for several years. Now we are seeing even newer trends in the Middle East, including BNPL and buy now, pay later, and so much is evolving. Middle East, actually, Dubai is one of the places that houses so many crypto exchanges. So much is happening on the technology in the Middle East that it is unbelievable, and that requires a specific focus by itself. But I can tell you one thing, that the growth in India is far, far, far higher than what you can expect in the Middle East, actually.
Thank you, sir. And the note back to Anup Singh is that there are lots of opportunities in Middle East. Stay focused, upskill yourself, and be ready for the opportunities that it is providing. I'll request Professor Prasad to come in and probably, if he would like to respond to the growth vis-a-vis employability matrix, the problem that the educational institutions will have to own up and start working on. Any comments on that? And after that, I'll wrap it up. Professor Prasad.
I think this issue is, slow to develop. There have been a number of policies. You've got NEP. You've got a number of things which are being talked about. But I think when it comes to implementation, as well as the resources which are devoted to it, a lot of it is still dominated by the public sector, and the money is not yet come in. And second is, I think there is an issue of mindset change. What has been happening in the past, the emphasis which comes from, say, accreditation agencies, for instance. Educational institutions are very concerned about how they are accredited and what kind of grades they get. And therefore, what they emphasize on is often not what is required by industry, and there is a gap there. I think if that incentive system is corrected, it is there to some extent, but it is not yielding the kind of results. I think that's the comment I'd like to make.
You mean to say that the quantum of energy required to work on accreditation process is least appreciated by the industry?
What I mean to say is that the faculty energy which goes into accreditation process for the goals which have to be met, primarily as well as secondarily, if they are aligned to what is required by industry, by the institution, of course, incentivized by the accrediting agency, then you've got the pathway right. That pathway is not right as of now. So people go after the ranking, but that ranking is not reflecting in employable graduates to the extent required.
Absolutely, absolutely. There needs to be a shift in the parameters of accreditation process itself. If it is attuned with the expectations of industry, then we are in the right directions. The energies will fructify in the desired results that the industry at least will hope to have education institutions producing that result. Yeah, fantastic. Thank you so much. Sir, we are at 8 p.m. India time, and we would like to close this with your permission. And I wanted to thank you for your time, energy, and expertise in providing us a fantastic picture, lots of data, and your own inputs in terms of those parameters that you have listed out. There could be several others, but the big 5 you have provided, and also the themes that you have outlined in terms of, say, 10 themes. Very useful, very educative, and some of the interactive questions that we have been able to provide here and facilitate also have additionally clarified what's been going on in the minds of various analysts. I think the entire session is an analyst delight. It's very, very useful for various sectors like manufacturing, e-commerce, sales, marketing, education, entertainment. I think several dependent sectors have got lots of cues to work upon. And also, this has been not just India specific, it's been global specific, but largely one can make out that this analysis is prepared by an Indian at heart, that is Mr. Raghu. I think whether it is made by Indian or not, you cannot ignore two economies comparable, that is China and India, and the kind of gap that one can mitigate. And the projected risks and opportunities gives us some hope that in the next 2.5 decades, I'm sure the writing is on the wall. We are all poised to win. But definite threats are there, definite hurdles are there, definite traps are there in terms of growth in income levels as well. One needs to focus on this. Greater political stability will steer all these things, and I'm sure in the days to come, in the next 2.5 decades, we'll be a nice nation and a force to reckon with. On this happy note, very, very optimistic as well, I want to thank you for providing us with this clarity and knowledge, sir. We would love to come back to you with a summary of this session. And once you approve that, we'll host it on our archives, so that the members who have not attended the session today will go back and look at that session along with the summary. It will be very, very easy for them to understand. Professor Ved is writing these summaries. We'll request him to attempt one more summary for this amazing section. He knows you, and he was quite excited about the topic when you shared the topic with me.
Where is this in ICFAI now?
The heart is in ICFAI, so the rest of the things do not matter. So I'm just kidding. Professor Ved is in Hyderabad. He's not with ICFAI. But he works very closely with us and advises on these matters. He writes summaries for these leadership conversations. All the 130 conversations were summarized by him.
Very nice. Okay.
We have published one book on these summaries. I'll share that copy with you, sir, whenever I get an opportunity of meeting you, or I'll courier it to you.
Sure. Please say hello to Ved. He's a good friend. We work together in ICFAI.
Yes.
So it's always a pleasure to know my past buddies, actually.
Great. A lot of them will be going through these live conversations on Facebook, YouTube, as well as on Zoom. I will additionally write to them and mention that you have thought about them and especially talked about the old buddies. Thank you, sir. Thank you once again for this amazing conversation. Ladies and gentlemen, I would like to thank you for your presence and wonderful questions that has provided a lot of meat for discussion today. And I'm sure this thinking will continue, this discussion will continue in our own circles. We need to read up quite a bit. The slides and the data that are provided are directional, and I'm sure we will try and share those slides with you with the permission of Mr. Raghu. Once it is available, we'll share it with you, and also we'll do the summary. Please go back and read additionally. And once you listen to this conversation on the video format as well, I think it will become much, much clearer. Very, very strong subject, very intense, lots of numbers, and that's the way it has to be pursued. This is a completely different conversation from the last 129 conversations. I'm very happy and thankful to Mr. M.R. Raghu. And we'll see you next week on 15th of December with yet another topic and the leader. We are going to talk about how technology is changing the landscape of finance and what are the lessons there for us. So it is Finance 2.0. What are the pitfalls and what are the peaks that we can see in the years to come. So tune in, come back on December 15th, 6:30 p.m. on Friday, and we'll be very happy to converse with you and take your questions as well. Good night to all of you.